closing the transaction, you're so close to earning a commission check. It's not even funny, but we're not quite there yet. A couple of forms and disclosures that will be necessary for your buyers who are obtaining a mortgage will be this loan estimate form and the closing disclosure form. So it starts in the beginning with the loan estimate form. Once you get an offer put together with your buyer and they meet with the lender, they will get this loan estimate form and they have 3 days to review this information that's proposed by the lender with all the details of the costs of obtaining that mortgage. They've got 3 days to review it. Now, that doesn't mean 3 days and then they can get out of the contract. It means 3 days with the lender that they have to review and accept that proposal. Then at the end of the transaction, before it closes, 3 days before closing, the lender must provide them with a closing disclosure that again is an accounting of all the figures and all of the fees related to obtaining this mortgage. It's part of Regulation Z and RESPA. Both of these forms are. The key is whatever the lender quotes as fees on the loan estimate must match exactly with the closing disclosure, or it can result in major fines for the lender and the bank. So what are these fees that must match? Well, the key term for it is triggering terms. Again, that refers to anything that would affect the cost of obtaining that mortgage. The annual percentage rate, the interest rate, closing costs, loan origination fees, the cost of an of appraisal or of pulling a credit report. All of those things, again, must match in the loan estimate with the closing disclosure form. Now, I gave you an opportunity to look at a sample loan estimate and closing disclosure, but I want to dive into this closing disclosure a little bit more for you so that you have an understanding of how those escrow accounts work. So I believe your last little bit of reading in the last little subsection was about escrow accounts. And again, escrow accounts are used for other people's money so that they're in a safe space. We never put them with the general funds of a broker or a closing company, title company, or an attorney's office. It's other people's money that we must protect. Moving it over to general funds would be commingling, or another word for it that you might see as conversion. Highly illegal. And these escrow accounts do get audited by some sort of state entity. In real estate, we have a trust account auditor that manages our local broker escrow accounts with the real estate commission. So this is a very, very serious thing. And we'll talk more about trust accounts, how they apply in Iowa when we get to the state section. This is the accounting of what's going to go in and out of that escrow account. So the overall idea is we set up this escrow account for the buyer, and it is going to get filled with their down payment on the house, any closing costs or fees that they owe, and the bank is going to wire in the mortgage amount. And that's going to give them this total amount that they need in order to settle this transaction. Then we're going to take that money and we're going to start paying off this seller's bills so that we know it gets done. And then they are left down here at the very bottom with what is hopefully a proceeds that they can use, maybe even to go and use as a down payment on the next closing with you, okay? But let's start here on the buyer side. It looks like the total that we need from this borrower at closing is $189,762.30. They purchased the property for $180,000, and they've got $9,682.30 in closing costs. This number we're going to pop up here to this closing cost detail and see this number here matches. So this is the itemized detail of all of these closing costs. Look, it looks like they had about a 1/4 point loan origination fee and application fee. These are all things that had to do with them obtaining a mortgage. So all of these costs must match what the lender quoted them on the loan estimate form. It's here on the closing disclosure. So we took that total where it's itemized here on this page. We took that total and transferred it here. Now we've got an adjustment for items paid for the seller in advance. So the seller prepaid what looks like an HOA due that was due on April 1st. The seller paid the entire month's dues, but now the buyer owes the seller a credit for the time of closing until the end of the month, where now the buyer owns it. So it looks like, because we're closing in the middle of the month, those HOA dues were probably $160. The seller paid that at the beginning of the month. Obviously, they lived there for half of it, and now the buyer's going to live there for the other half of the month. So they owe a credit to the seller. So we're adding that to the total that they need at closing. Then these are the things that are already going to be paid on their behalf. Looks like they made a $10,000 deposit for earnest money. The loan amount from the borrower is $162. That amount was wired in from the lender. Looks like this seller offered them $2,500 to help pay towards their closing costs. That probably is actually technically going to offset the $9,682.30. Looks like they got a rebate from their title company. And now we've got taxes. So up here with these HOA dues, we had a prepaid expense, a debt to the buyer, a credit to the seller. Now we've got unpaid items, or what we might call accrued items. This is going to be a debt to the seller and a credit to the borrower. And this is for property taxes. So property taxes in this instance are from January 1st to December 31st, and then they're due. So the reason the seller is giving them a credit at closing is for the time the seller owned the property, January 1st to April 14th. And we're going to give that money to the buyer so that when the taxes are due at the end of the year, they're made whole. So they've got the tax amount from April 15th through December 31st that they'll pay. And they've got this credit from the seller, again, for the time they own the home, but the taxes are not due yet. So we've got this total amount plus their credits. This $14,147.26 represents the amount that the borrower needs to bring in cash to closing. And typically lenders will want that in some sort of a certified check. And most lenders will coach the borrower on how to take care of that and how to bring that money to the closing table. Now let's look at the seller side of the transaction. They have got credits of $180,080. So again, we sold the property for $180,000, and then they've got this credit for the HOA dues. And now we've got the total due from the seller of $115,665.04. Great at reading numbers, aren't I? These are the bills that we're going to pay on behalf of the seller, so we know for sure it gets done. Otherwise, it may not release a lien that we need in order to settle this transaction. So first of all, we've got closing costs of $12,800. Let's go back up here to this itemized sheet. The seller paid figures are here. Looks like they've got a transfer tax, or what we in Iowa call revenue stamps. It looks like they provided a home warranty for the buyer. And then look, there's commission dollars One of these has your name on it, right? For your broker, so I can get you paid. And then these totals equal the 12,800. We transfer that here to item N line 2. Then we're going to pay off their mortgage. That way we know it's settled. Now, as we learned in the mortgage section, there is an alienation clause that they signed when they got this mortgage that said when they sell the property, they will settle this with the bank. That's what they're doing. We're going to pay it on their behalf so that we know it gets done. Then again, the seller gave a credit to the buyer, probably for some closing costs, and they've got a debt to them for those property taxes, again, for the time they own the home, the 1st of January to the 14th of April. So we've got their total credits minus their debts, and the $64,414.96 represents their proceeds that, again, hopefully they're going to take to their next closing with you when they buy another home. Okay. This is a few other disclosure pages, but these two I think are really kind of the meat of how that escrow account works and how we itemize all of these fees between the loan disclosure and the closing disclosure. Hope that helps, and we will be moving on to the next section.